Welcome to Investment Insights 2019. Today, I have Rob and Philip with me. Welcome both. Robert, global markets are off to a promising start this year. However, an equally impressive start to 2018 has resulted in one of the worst years in a decade. What happened last year?
That's right. The last quarter of 2018 was a tough time for investment assets. Things were looking pretty good for the year. Then in October, we saw the sustained run of global share markets come to an end. This resulted in the first negative calendar year for shares since 2011. Global share markets tumbled nearly 13% in the December quarter, and there were three key things that contributed to this sell-off: rising interest rates in the US, trade tension between US and China, and slowing economic growth. We saw investors selling risk assets like shares and buying safe haven assets like sovereign bonds, which are one of the few asset classes to do well. Investment funds experienced one of their toughest quarters as a result, and this can be seen in their fund returns in the table. The more conservative funds fell less, but also experienced a negative quarter, while funds with more growth assets fell by more. These declines follow a very strong period for fund returns, as can be seen if you look at the 3-year returns, which remain solid despite the sell-off we just experienced. And while it was a tough time during the quarter, we're pleased to report that our funds provided some insulation against the market declines because of the greater degree of diversification. Our funds were amongst the top performing funds in the market over the quarter across a number of categories.
So it sounds like shares had a tough time last year. How did that compare with previous years?
Each year, Mercer produces its periodic table of investment returns. The table shows the returns of shares, as well as a range of asset classes, and ranks how each of them performed on an annual basis over the past 10 years. The table can be found by clicking on the link below. A quick glance at the table shows how one year's winners can quickly become next year's losers, and vice versa. If there's one thing the periodic table tells us, it's that after a downturn, riskier asset classes frequently return to have their time in the limelight. The challenge is knowing when. The volatile nature of markets continues to be a reminder of the benefits of diversification and maintaining a focus on the longer term.
Philip, what might happen next year? And is there still room for growth?
Well, we think the scale of the share market sell-off late last year wasn't justified by changes in fundamentals. Even though economic growth has slowed, we continue to believe that a global recession is unlikely in 2019 because the growth outlook still remains solid. The risk of a recession being triggered by higher interest rates has receded, with the hugely influential US central bank, the Federal Reserve, becoming more cautious about lifting interest rates in the United States. And in addition, the Chinese government has started to take measures to help offset the slowdown taking place in the Chinese economy. While the outlook for company profits has softened, some positive growth is still expected in the US and elsewhere. All things considered, to us, valuations for shares and other growth assets are more reasonable now, particularly when compared to defensive assets like bonds. There will of course continue to be ups and downs, and as you saw with the periodic table over a period of many years, currently the markets are still needing to navigate risks such as Brexit and the challenging US political environment, exemplified by the temporary US government shutdown we saw earlier in the year. Closer to home, the slowing housing market presents a risk to growth, which is what we're seeing unfold in Australia at the moment.
What's Mercer's investment approach for 2019?
While we're pleased with the way our funds negotiated the market declines, as Chief Investment Officer and an investor in our funds, I'm focused on working to continue to capture as much of the market growth as possible, while providing some insulation from the occasional but inevitable declines. Our process continues to be to invest in well-diversified portfolios, to use only those active investment managers we believe can generate returns over and above the market, and then thirdly, to tilt our allocations to reduce exposure to those assets we believe are materially overvalued, and we think that bonds still fit in that category, while adding to those assets we believe are more attractive, such as emerging market shares.